Good afternoon. This is Gregory from Taxpatria. I think we can slowly get started because the initial time for our presentation was 3 p.m. CET, so likely a few more visitors will join us later on. Thank you again for joining us in this third online presentation this year. It's the third time we do a joint event with another tax firm after US and Portugal in spring. We now have the, let's say, honor to invite Michael Gauci from Corrieri Cilia in Malta. So maybe I'll just give briefly the word to Michael that he can introduce himself, and then we can get started to give you some, let's say, insights in personal and corporate tax residency and how to structure things in Malta. So Michael, I give the word to you.
Thank you, Gregory. First of all, it's an honor to be here, and thank you to Taxpatria for hosting us. Corrieri Cilia is a tax firm at its core. That is our bread and butter, and it's what we take pleasure in doing day to day. We've also now expanded to become a more multidisciplinary firm based on the needs of our clients and the general trends. And we also operate a corporate services provider, which kind of gives us that advantage into being exposed to both the advisory side of things and also the implementation side of things. And again, it's a pleasure to be here.
Thank you, Michael. And I understand the firm you present is both assisting private clients and corporate clients.
Yes.
So you have a practice that can assist both. Accounting, is it also something that you can potentially assist with, or is that outsourced?
Yes, indeed. So we do provide a full bookkeeping service through our corporate service provider, or I should say one of them. We don't provide audit services because that's an independent service, but we could also source that kind of service for clients. Yeah.
So if potentially a Belgian client would be interested either to move to Malta or to set up a business, you could basically assist him from, let's say, beginning till he's fully up and running.
Exactly, correct. From beginning to end.
Perfect. Okay, great. So the presentation for today, I mean, in previous presentations, we sort of followed the same outline. We have the first part that we focus on today is the personal relocation. So how do you go about in establishing domicile and residency in Malta? What programs are available in order to get local residency in Malta? How does it go with buying property? Which regions should you look to potentially buy and where to potentially avoid? So all of those things, Michael will shed some light on. And then as sort of like the Belgian side of things, we're not going to spend too much time on that because this event is mainly focusing on Belgian clients potentially moving abroad. But we're just, for reasons of completeness, we'll just go through this part as well. When are you a Belgian tax resident, and what specific rules apply in Belgium as a sort of comparison to how it works in Malta. The second part, after the personal move and personal tax residency, the second part today is actually the business setup. So how do you go about in establishing a company in Malta? What are the characteristics? What are the requirements? And of course, a very important topic is the effective tax rate. So I understand that Malta works with a tax refund system, but of course, more on that later on. And then the third part of today, maybe not that interesting for everybody, but we do focus on crypto a lot, especially within our firm. We have quite a few clients in crypto, and they're always, of course, interested to see if there's other interesting location to potentially set up a business or to potentially move to when it comes to crypto taxation. So again, also on that part, that's going to be the last part of today's presentation, is how it works specifically in Malta in respect to crypto. The first part, then I give the word back to you, Michael, is tax residency in Malta, and then we'll come back to the Belgian part later on. So I give the word to you.
Thank you. I'll just take over and make sure that I have control of the screen. Okay, so the first thing we'll discuss is the concept of residence and domicile. under Maltese tax law. And what's important to note here is that Maltese law tends to follow suit from UK common law, in that we split the concept of residence and domicile when it comes specifically also to tax treatment. I'll just go back quickly to the previous slide, if that's okay. Let me just say a short thing about residence, because I will be discussing domicile first. But what I'll be doing then is, what I want to do first is just let you know a bit about residence, which is that residence in itself from a Maltese perspective is not purely a matter of legal definition, but is rather also a matter of facts and circumstances and intent. And I'll get into that shortly. So if I go to the next slide, which is on domicile, domicile tends to denote something that creates a much stronger tie to a country. There's more of a permanence to domicile, not to be confused with permanent residence, but we talk about the concept of having that home jurisdiction, your home state, and perhaps a little bit morbidly, we talk about intending to live and die in that state. So it goes beyond purely the physical state. It's a matter of true permanence. Although even under Maltese law, we recognize a number of different forms of domicile, the two major forms you may come across would be the domicile of origin or domicile of birth, which you would generally expect an individual to acquire by means of birth. And it's normally referred to as the place of domicile of the parents. Normally, it is the father's place of domicile, but then as you get into certain different circumstances, the mother's domicile may also apply to a specific case. Then you have what is called a domicile of choice. And this tells you that the law recognizes that domicile may be changed by the person, and it's acquired when you actively take steps to create a permanent home in another country, not simply, again, residence for an indefinite period, but you're taking concrete steps to become permanently tied to that specific country. Some important notes here, yes, the Maltese law recognizes that no individual can be without a domicile. You may not have more than one domicile, contrasted to residence, where you may have more than one residence. And in all cases, so even if you actively take steps to abandon one domicile, you will likely fall into a previous domicile, ultimately, or domicile of origin. Going back to residence, so, and I'd like to focus a little bit more on residence because, like I said, the Maltese taxation, when it comes to non-domiciled persons in Malta, is based also on their residence. And like I said previously, it's entirely a question of intent and the matters and the facts and circumstances that apply to that person. So then you begin looking at things like person and economic ties to Malta. You look at what intent that person is displaying. And whilst we don't have a pure definition at law, even the law recognizes this. So to quote, and you can see here, the law recognizes a tax resident of Malta as being an individual who resides in Malta except for any temporary absences. As to the Commissioner of Revenue, may seem reasonable and not inconsistent with the claim of such individual to be resident in Malta. So what that tells you is that the law itself does not give you the strict definition of what is considered to be a resident, but it propounds these aspects of facts and circumstances. It's important to note that, and you may have been reading into this and you may have come across a number of references to the 6-month or the 183-day rules, which actually, strictly speaking, is not enshrined in Maltese law, although we do have the concept of a temporary resident being someone who is present in Malta for less than 6 months. However, the revenue has recently issued guidance where they've said specifically, as the Maltese Commissioner for Revenue, that persons residing in Malta for more than 183 days would be considered to be resident in Malta. That is not the be-all and end-all, but it's a way of semi-formalizing the 183-day rule into how we interpret tax residence in Malta. And then,
Michael, if I just may jump in here, because we have a similar situation in Belgium. A lot of people think that if they overstay 6 months, they're automatically considered a tax resident. But I understand then in Malta that would not be the case. So if you, let's say, stay 4 or 5 months, based on the circumstances, you could still be considered a tax resident, even if you're not overstaying 6 months.
Exactly, yeah. Because then if you fall back on the provisions of the law, if you display that intent to be so resident in Malta, then you could still be deemed to be resident, even if you haven't elapsed the 183 days, which I think kind of is a good reason to keep that rule out of the law itself, because you don't want to give the impression that you've said, that you've referred to now, in fact. Yes.
Yeah. Okay. Yeah. Thanks.
When it comes to then, so we also have the concept of ordinary residence in Malta, being ordinarily resident and domiciled in Malta, which again doesn't denote a specific period of time, but you obtained once you've displayed or evidenced a certain permanence in terms of being resident in Malta. Not to be confused, I know this gets a little bit confusing, but not to be confused with the permanence I mentioned in respect of domicile, but it's rather indefinite stays. Now, I've kind of amalgamated the tax treatment of residence and domicile. So the tax treatment that also applies to the programs that you can fall under when you are a resident non-domiciled individual in Malta. And this is important because as myself personally, for example, as an individual who is both resident and domiciled in Malta, I would be taxed on my worldwide income, wherever arising, and whether or not remitted to the country, subject always to any provisions of double tax treaties or any relief. But then the law recognizes that where you have a person who is a Maltese resident yet not domiciled in Malta, the taxation shifts from a worldwide income basis to a source and remittance basis only, which now begins to make it interesting for persons who are non-domiciled, who are looking to move their residence to Malta. So essentially, persons who are resident non-domiciled would not be subject to tax on income arising outside of Malta unless you remit it into Malta, so unless you bring the income into Malta. There is no tax on foreign source capital gains, so on capital gains arising outside of the country, even if they are remitted into the country. What is tax then would be remitting income into the country, into Malta, and also generating income in Malta, which then would be taxed depending on the regime you fall under when you've moved into Malta. So what I've done here is split. I've shortlisted 2 programs per EU nationals and non-EU nationals. So essentially, when talking about EU nationals, Malta being an EU member state, individuals may move to Malta and may exercise their freedom of movement within the Union and establish their residence in Malta. There is a small formality of registering yourself as a resident in Malta, but essentially by virtue of doing that, you would, subject that you are then ordinarily resident in Malta, you would become subject to tax on a source and remittance basis. That's it. Now, this makes it interesting because it assumes, so it's very attractive for those persons. Therefore, if you had to be looking at your tax considerations in Malta, and you would be thinking, okay, so foreign sourced income is not taxed unless remitted to Malta, and capital wouldn't be taxed whether or not you remitted. Therefore, at this stage, if a person looking to move to Malta had a significant amount of capital at their disposal and they could live off that capital and of remitting capital into Malta and subsisting of their capital, then it would be very beneficial for you tax-wise. However, then what we have is also a regime that you may apply for that is attractive for persons who would need to remit certain amounts of income into the country in order to subsist. And for that, the country offers what is known as the residence program, meaning that in this case, when you remit, if you are a beneficiary of this program, you may remit income into Malta, and instead of being taxed at the progressive rates under the ordinary regime at up to 35%, you would be subject to a flat rate tax of 15%. So it would be more, this would be more attractive for persons who would necessarily need to remit income into the country. There would be,
Michael, just sorry to interrupt you. What is remit actually? Does it mean you transfer from a foreign bank account to a Maltese bank account? Are there other ways to remit? What exactly would that mean in this context?
Excellent question. Yes. This is in fact, so the question we get asked all the time, in fact, is, so if I use my credit card in the country, is that a remittance? Yes. So any way that you, number one, yes, make bank transfers from a non-Maltese bank account into a Maltese bank account, that is a remittance. If you are spending using a credit or debit card in Malta, that would also be considered to be a remittance. And where it falls then is to identify whether or not that remittance was of an income nature or capital in nature.
Okay. Yeah.
But generally, yes, any kind of spending in the country, with even purchasing a property, for example, would be deemed to be a remittance. The programs have some certain requirements, such as property ownership requirements and registration fees, which should be considered. When we speak briefly about purchasing property, we'll talk about what properties might be more attractive to you if you're considering moving to Malta, since normally, in order to satisfy the requirements, if you purchase or rent in Malta, in the south of Malta, the minimum requirements are lowered significantly. So you can see in terms of property ownership, if you're purchasing in the north, the minimum value of the property would have to be 275,000. If not, or if purchased in the south or the island of Gozo, you would only be required to pay 220,000 euros. Otherwise, you may also rent, and those are the minimum annual requirements for rental, which you would need in order to benefit from the residence program. At this point, I think I can move forward. Just one interesting thing here, which is again a reflection of the recognition of the 183-day rule, is that a beneficiary of these programs would not be able to spend more than 183 days in any other jurisdiction in the year. Therefore, it assumes that you are not residing in any other place for more than 6 months or for the 183 days.
So the understanding there is that you're not a tax resident anywhere else, basically.
Exactly, correct.
Yep, correct. Yeah.
So just to recap very quickly, as a standard regime, you have a regime that's geared towards, or maybe more favorable towards, bringing capital into the country. And if there's any questions on the capital versus income, we can deal with, we can field those later. However, you also have alternative programs which are geared more towards the requirement of certain, especially high net worth individuals, to have to remit income into Malta in order to subsist. One more thing before I move ahead is that under the ordinary regime, Malta's recently also introduced a minimum tax, which equates to around 5,000 euros per year, but which is not always payable in certain cases. So you'd have to speak to your friendly Maltese tax advisor, being us, to give you more details on that. Sorry for the shameless plug, Greg.
No problem.
Now, for those persons who are not EU nationals, you would also be able technically to benefit from the same regimes. However, non-EU nationals wouldn't benefit from the freedom of movement in the EU. So Malta has what is referred to as the Malta Residence and Visa Program, which itself does not confer a tax status on the individual, but is more geared towards granting the right to live and travel within the EU. However, obtaining this visa would, obviously, since you would be allowed to reside in Malta, would mean that you are subject to the standard non-domicile tax treatment, meaning you're taxed only on that source and remittance basis. Similar to the residence program, we have the global residence program, which has just about the exact same requirements and same benefits to the residence program. So generally speaking, whether or not you're an EU national, there is always a program that will suit you if you're looking to move to Malta. I'll move on. So, first of all, one thing I want to clarify is that when you, under the standard regime, there is no property purchase requirement. That being said, we've seen an increase in interest in actually purchasing property as opposed purely to renting property, specifically because Malta has quite a thriving property sector at the moment, and we're seeing a rise in investment from non-Maltese nationals. But very briefly, what I'll say is that so when buying property for the buyer, it tends to be a very straightforward process. In terms of taxation expenses, you can expect to pay only stamp duty, which varies between 2 and 5% on the property value. There is no property transfer tax that is payable by the purchaser, and there are no VAT considerations when you're buying a property. And
and you typically buy property through a notary public in Malta or a land registry, or?
So exactly. So what you would do is, once you've identified the property and you've negotiated with the seller, the buyer has the right to source their own notary. Well, I say their own notary. The notary is a representative of the government. However, the buyer has the right to select a notary whom they have more confidence in, and lead that kind of side of the purchase. And what would happen normally is either you would arrange to purchase the property via a deed immediately with the notary, but in practice, what happens is the buyer and the seller enter into a promise of sale agreement. During the time that the promise of sale agreement is active, you would expect that the notary would conduct the root of title searches on the property. You may take an architect to inspect the property and ensure that you're happy with the title on the property and the permits on the property, and then eventually you would move on to the deed of sale, and that will be published by the notary.
Okay. And can you give an idea of fees that a notary would typically charge, depending on the value of the property, or is it free at will to charge to the client, or how does it work?
The notary, it used to be free. The notary used to be free at their own will to charge the client. However, more recently, the Notarial Council has instituted a standardized fee structure. In fact, it's very easy. You can go on the Notarial Council's website, and you can actually work out the fees that it would cost to purchase a property. What I would normally expect is the fees to amount to around 1% of the property value, usually. It depends. It depends on how complex the root of title is, whether there are a number of amendments to the promise of sale, whether there are a number of extensions before entering into the deed. But essentially, it's around that much.
Okay. And would you typically still, as a buyer, need to consult with, like, for example, your firm in the buying process, or would the notary sort of provide first line advice on everything in the client's interest, or how would that go about?
So what's important in that case specifically? So first of all, you do not strictly require legal representation when entering into a promise of sale or a deed. However, I do strongly suggest it because, first of all, the notary is, like I said, an independent party. They represent the state, and therefore the notary does not go one way or the other when it comes to buyer and seller. You can expect fairness from a notary and a certain level of due diligence. However, then there are certain situations which fall to be a matter of law and custom, whereby you may need, and I would suggest that you do consult a lawyer or legal advisor in this matter. We do provide the service, yes, but in all cases, I always suggest obtaining legal advice. Also, because an experienced lawyer would be able to give you more insight as to certain customary expectations. The payments of the deposit. Sometimes you may see that a seller pushes to receive the deposit on the property as soon as possible. A deposit isn't even a legal requirement under Maltese law. So that would be obviously a matter of negotiation, but it's also important to identify these not minor things, minor things which seem small but may have major consequences for you. So with that said, I'll go to my favorite slide, which is taxes on owning property being none. Gregory's been kind enough to include a visual on the Maltese islands here, which I can show you. I'm not sure if you can see my mouse on the screen.
Well, I can. I'm not sure if viewers can,
but basically what I say is that if you look at the islands, so in the geographical south, that would be the southern part of the island, which I mentioned, where if you're making property purchases in terms of requirements under the tax programs, sorry, the residence programs, then you would benefit from lower fees and lower requirements. Buying in the north, excluding Gozo, would mean the standard fees would apply. By way of preference, Gregory, I tend to prefer the north of the island, but I mean it's a mix. It depends what you're looking for. You tend to find more classical architecture in the south. You also tend to find a lot more traffic. So I tend to prefer to be as far north as I possibly can on the island.
Yeah. Okay. And particularly is Gozo interesting because in terms of connectivity and those things, is Gozo let's say up to the standards of Malta, or if you really want to have a bit more connected and lively place, I guess Malta, let's say the Malta island itself would be more recommended to purchase, or is that a wrong understanding from an outsider?
We love it. We lovingly refer to Gozo as Malta 10 years in the past, or sometimes even 20 years in the past. That doesn't mean it's not a great place to live. I mean, in terms of connectivity, I mean, talking about communications and travel, it's very simple to get to Gozo. It, relatively speaking, doesn't take too long. But it's a nice place to get away from the hustle and bustle of Malta, if you could consider Malta to have hustle and bustle. But most people like to holiday there, retire there also. But unless you need to be traveling down to the main island, to Malta constantly, Gozo is also a very attractive place, and property prices tend to be significantly lower than Malta.
Okay, but Gozo becomes, I think, then more popular in recent times.
Yes, there's been quite an increase. So there is that kind of buzz around. It's nice. There's a good vibe in Gozo.
Okay.
Yeah, very, very attractive also.
Yeah. Okay. Thanks.
And ultimately, just a brief slide on selling property. So this is where you would expect to incur property transfer taxes. Again, this would generally be the tax treatment you can expect when it comes to selling property. And like we said, when it comes to purchasing property, you would expect the same procedure when it comes to you now selling your property, meaning that you would likely enter into a promise of sale and eventually move on to a public deed, which is drafted by the notary. That might be, yes.
Okay, yeah. Again, I see already a few viewers posted questions in the chat. So if you have any questions on whatever we discuss, please feel free to post your questions, and then we'll come back to them after the presentation. So we have, let's say, idea to close the presentation after 45 minutes, but I think it's going to be a bit longer. But then afterwards, we'll address your questions. So in case you forgot, you can post everything in the chat, and we'll come back to that afterwards. And then just a few words on the tax residency in Belgium. The approach here is, I think, quite similar as the Maltese approach. The 183-day rule in Belgium is also not, let's say, written in stone, because it's all a matter of facts and circumstances. So what triggers tax residency in Belgium? That's mainly registration in the National Register. So if you say, I have the intention to stay in Belgium long term, which is in immigration terms more than 90 days, then in that case, you are legally required to register at the city or town hall municipalities register. And in that context are required to, let's say, provide an address where you're going to stay, which is in that case linked to your domicile. And then it creates the presumption that you're a Belgian tax resident. Now, if you're single, and that's an important element, because if your married partner or legal partner is with you, then you're no longer able to challenge the tax residency. Then the Belgian authorities say, for us, you are taxable on your worldwide income in Belgium. But if you're single, then you have the option to, let's say, challenge the tax residency and demonstrate to the Belgian tax authorities that you have closer economic and social ties with another country. Again, it's a factual appreciation, so it's not that the authorities will then accept you to be a non-resident for, let's say, the next 10 years. It doesn't work like that. But typically we see that 2-3 years, they normally don't ask any questions, but then afterwards they may come back to you and say, okay, we understand that you have been a non-resident for a few years, only taxed on Belgian sourced income. We don't have the remittance-based taxation. We don't have that concept in Belgium. So it's only on Belgian sourced income only that you're taxable as a non-resident. But then after a few years, they may come back to us or to the taxpayer and say, oh, we understand you have been taxed only on your Belgian sourced income as a non-resident, but what has happened in the meantime? So then again, we may be required to prove that the economic and social ties with your home country are still in place. So yeah, it's on one hand pretty flexible to get a non-resident status, but on the other hand, it's also a bit, let's say, walking in a gray area because you're not really sure how long you'll be able to maintain this status. And at any point in time, it may be questioned by the tax authorities. It doesn't mean that the tax office is just going to then retroactively consider you a tax resident. It only works for the future. But yeah, it's a factual appreciation, which is on one side a positive thing, but on the other hand, may also have some create some uncertainty, let's say. The approach is that, like I said, registration with the local municipality. The general approach is that you are tax resident, either if you have established your residency in Belgium, or another concept that we use is that the seat of wealth is located in Belgium, which is, we see in practice, not used very often. What is a seat of wealth? Seat of wealth is where you manage your investments and your assets from. So let's say where you have your bank accounts, where your investment portfolio is based. But we see in practice that's not often applied to determine tax residency. So in most cases, the tax authorities blindly look at the national register and work their way up from there to either consider you tax resident, or if proven successfully by the taxpayer, that you may be able to consider the non-resident taxpayer. Then, of course, we have more than 100 tax treaties with other countries in the world. So the chance that you'll be double taxed is, let's say, relatively small, even if you would be considered a tax resident in Belgium. We have two ways to avoid double taxation. That's either with what we call an exemption with progression method or an effective tax rate. So that means that foreign exempt income will not be taxed in Belgium, but they consider the income to determine your effective tax rate that only applies to your Belgian income. It's always very abstract, and when I explain to clients how that works, I always need to show an example because it's, they say, oh, I'm already paying into the highest tax band, but it basically has nothing to do with it. It has to do with your effective tax rate. But going into detail on this today would lead us a bit too far. But that's the main exemption method that we use in Belgium. And for some cases, we have a credit method as well. So that means that the foreign tax paid can be offset against the taxable income in Belgium. But mostly we use this effective tax rate method. For some income sources like interest, dividends, and royalties, there is a sort of double taxation. And again, after so many years, clients are always still very surprised that even if they paid withholding tax in their home country on, let's say, a dividend payment from their investment portfolio, in some cases they come to us and say, look, I already paid tax abroad. Do I still have to pay tax on it in Belgium? And unfortunately, the tax treaties still allow double taxation, which means that you would have to pay additional 30% flat tax on foreign investment income in Belgium. And then there's still a municipal tax, which I'm not going to go into too much detail, but that's something applicable if you live in Belgium. That's basically the local community or local commune, as they say in French, or municipality that is allowed to charge a surcharge on your income tax. And that also applies even on foreign exempt income in some cases. So a lot of taxes in Belgium. Tax rates, well, most viewers today are from Belgium, so I'm sure they're aware of the high tax rates that we have. Like I said, in some cases, a non-resident tax status can prove to be, let's say, a way to mitigate your overall tax liability. When it comes to real estate, just to make the comparison to Malta, well, we do have quite a bit of income tax on, let's say, the ownership of real estate. There's also a transfer tax. So we don't have a stamp duty, but we have a transfer tax, which could be up to 12.5% in Brussels. They do provide discounts and tax relief in some cases, but yeah, the approach is quite different than in Malta, I understand. The situation if you own property but you rent it out is that, and that's quite unique, we don't tax rental income, we tax deemed rental value, which is actually what we call a cadastral income or cadastral value. So every property in Belgium has a deemed rental value, and that is used for income tax purposes. So even if you would, let's say, ask €1 million rental income per year, you're not going to be taxed on that if it's rented out for residential use. You're only going to be taxed on a deemed rental value, which is in most cases, let's say, 1/10 of the rent you would ask. So it's a very favorable way to create income without paying too much tax on it in Belgium. So that's one of the few, let's say, areas that we are quite beneficial for. If you're a non-resident, there's some specific rules that apply in case of owning real estate in Belgium, renting it out, but living abroad. So again, if that would be relevant to you, you can always contact us. But it's only above a certain threshold if the cadastral income exceeds a certain I'm going to give the word back to Michael when it comes to the business setup in Malta.
There you go. So I'll go as quickly as I can through these to save us some time. But essentially, when you're starting with a corporate setup, always first consider what makes most sense to your goals. Malta has a number of different entities you may set up. I've listed just a few here. We have the most popular one being the limited liability company. But we also have the concept of partnerships, both a non-collective and commandite, being limited partnerships or a mix of having general and limited partners. You may also have Maltese branches of non-Maltese companies, which themselves would benefit from a similar resident non-domiciled regime of taxation. You also have the option to re-domicile companies into and out of Malta. And I'll go into the various considerations as we go along. So where you start essentially is incorporating a company always requires assistance from an authorized corporate service provider. These persons are subject persons and need to apply AML laws. So expect that when you are engaging a corporate service provider, you will need to provide significant amounts of due diligence depending on how your business's risk profiled. You will also need to submit due diligence to the business registry, although they are now working on kind of a streamlined due diligence submission.
Is that a service that your firm provides, Michael? Is that
also yes. So this is what I mentioned earlier, being the corporate service function.
Yeah. Okay.
So as a basic document, once you've been onboarded by the CSP, you will be asked to, if you are the shareholder of a company owner, the shareholder, you'll be required to review and then approve the constitutional documents, being the memorandum and articles of association. You'll also need to provide consents, meaning that the persons who you propose as directors of your company will need to give their written consent to act as director of the company. And you should also expect, in all cases, whether you're holding directly the shares in a company or indirectly, that the beneficial ownership for anybody owning the company to more than 25% will need to provide. So your information as a UBO will be reported to the business registry also. That was pre-incorporation. Post-incorporation, Gregory, if there's any particular questions, slow me down. I'll just be moving a little bit.
Sure. Yeah. I will.
Once you've set up your company, which is normally a matter of, depending on how quickly you can provide all due diligence documents, and those signed documents takes a number of days to weeks, possibly, depending on how complex your structure is and how quickly you can provide all your documentation. Things you will need to consider as soon as you're setting up are obtaining your income tax number, which happens generally the same day, almost immediately after the company is incorporated. If your company is intended to carry out a vatable activity and is required to register for VAT purposes, you will need to register for VAT, and you can expect to obtain a VAT number around, I usually say, 2 weeks from incorporation of your company. Not to say that you need to wait to operate for those entire 2 weeks, but the process of obtaining the number generally takes that long. Again, if you're intending to have any employees in the company, whether yourself as an employee of the company or other persons, the company will need to be registered as an employer in Malta.
In terms of, sorry to interrupt you, in terms of bank account opening, is that a complex thing? Is that something you assist with, or I presume the client would have to come to Malta for that?
So it is something we assist with. First of all, it's important to note here that you do not need to have a Maltese bank account for a Maltese company. You may have a bank account in any other jurisdiction. That being said, you may look to open a Maltese bank account. However, the process, especially with the traditional brick and mortar banks, is difficult because of their extremely low risk appetite. So we see persons who want Maltese licensed institutions more going for payment service providers. So, although now certain banks are becoming more amenable to foreign-owned companies, and it's possible, what we normally recommend is, if you are opening a company in Malta and you require a Maltese bank account, do go for the opening with a Maltese bank. However, always have a fallback option and open an account with a non-Maltese bank you're comfortable with, or that you've worked with in the past, and we can assist with both those procedures.
Okay.
Always consider whether or not your company will be conducting any regulatory activity, and always, and then I believe this is in most cases, you will need to consider that if you're carrying out any regulated activity, whether it's investment advice services, gambling activities, whatever it may be, you may incorporate your company before obtaining regulatory approval, but you may not begin to carry out any regulated activity before you obtain approval. So you can have your setup done, ready to obtain the approval, but not actually carry out the regulated activity. Also, social security implications, and think of this in terms of both whether you're going to act yourself as a director of the Maltese company, and whether or not you may need to be employed with the company. One thing I'll say here is that you do not necessarily need to be an employee of the company in order to be a director of the company. And this is where you would begin to consider whether or not it's more worth to invoice the company for your services as director, or receive a directorship services fee, or otherwise, for certain aspects of the directorship, become an employee of the company and exercise certain activities as an employee of the company. You do not need to be located in Malta to exercise that employment, but it's always worth looking into this and planning exactly what your needs are, and also talking to your advisor, in this case in Belgium. From that, just briefly, we apply residence in terms of the Maltese Income Tax Act to companies by applying 2 tests, namely an incorporation test, but also the reference to the control and management test. You will also therefore need to look at, yes, the application of double tax treaties to ensure that your company is tax resident where you want it to be, and that the management and control of the company is being exercised where you want it to be exercised. And in that sense, you need to make considerations in a number of different aspects and for a number of different reasons, as to, for example, what is your board composed of? What is the decision-making process of your board? You can structure this in Malta very flexibly, meaning that if you want to retain a certain element of control over the company, over the board of the company, whilst not being resident in Malta, you may do this. However, you need to keep in mind not to shift your management and control away from Malta in most cases. Same thing, you need to look at how often is your board meeting, where is the board meeting, do you have directors flying in, which is not necessary but highly recommended. If you have more significant operations in the country, always think about where those employees are placed, the value they're generating, and what the tax implications of that is, because we get asked on a very regular basis, hi, listen, I'd like to set up my company. I have an entire development team in the UK. I'd like to keep them in the UK, and can I invoice from my Maltese company? And then the question is, okay, but you're generating value in a different country and not in Malta, and we'd look at the tax implications of that. And then also, yes, having physical office space, equipment at your disposal, specifically at the disposal of the company. These are all considerations you're going to want to make when looking at boosting the level of your substance in Malta, and planning accordingly. And just briefly, yes, like I said earlier, we also have the concept of resident non-domiciled companies, meaning that you may have non-Maltese companies which are incorporated and exist outside of Malta, which however have either a branch or a place of effective management registered in Malta, and therefore from a Maltese perspective, you're seen as a resident non-domiciled company in Malta, and you're taxed on that source and remittance basis we discussed earlier.
Yeah. Would the Maltese tax authorities have an interest to challenge one of their own, let's say, Maltese companies to challenge whether they are indeed tax resident in Malta? I guess that would mainly come from, let's say, another country, let's say Belgium, where the directors live, and they would say, okay, you are running everything from Belgium. We trigger tax residency, and we understand that in our analysis, the Maltese company would be considered Belgian tax residents. But I guess there would be little interest for the Maltese authorities to challenge one of their own companies, let's say, on the basis of their tax residency.
I would agree with that. In fact, and the law kind of shows you this, because, for example, initially by virtue of the incorporation of the company, you're already deemed to be resident in the country, and that's the one test you have. But again, Malta, even as a matter of policy, looks at inviting business and investment into the country. So like you said, maybe the appetite for challenging whether you're or not you're resident would be more of an external issue rather than a local issue.
Yeah.
But then again, obviously, I mean, Malta has obligations towards other countries, has a responsibility towards other countries, and ensuring it's not damaging other countries by its tax practices. So there's also a good level of cooperation between Malta and the tax authorities. But yes, the bottom line is the considerations are usually look at the other jurisdictions that may look at the Maltese structure and make the case that they do not agree that the company is resident in Malta for tax purposes. This we can do very quickly because I'm conscious of the time. So in terms of the general composition, you have the shareholders of the company who are the equity owners of the company. They possess a separate and distinct legal personality from the company, and therefore their liability is limited only to any of the share capital in relation to the equity that they own that remains unpaid. I'm going to skip through these basic requirements, Greg, but essentially you must have at least 2 shareholders unless you obtain an exemption to have 1 shareholder in the company. One thing I wanted to mention, and this we get this a lot from our US clients generally, is that people tend to fail to make that distinction between the members of the company or the shareholders and the directors, usually because when they come from jurisdictions where you have the concept of a member-managed LLC, for example. What's important to note here is that the legal and judicial representation of a Maltese limited liability company is, in most cases, vested in the directors of that company. A director of a Maltese company does not have to be a Maltese national or even a Maltese resident, and you could even, in most cases, have another limited liability company or legal entity acting as a director of a Maltese company. One thing to consider here is always remember that the directors of a Maltese company are unlimitedly, jointly and severally liable for any breaches of their duties. And with very few exceptions to this rule. So it is an onerous role. Consider this both if you intend on becoming the director of a Maltese company, and also consider this if you are engaging any other directors to become directors of the entity.
Maybe just to jump in here, because I saw it's one of the questions of the viewers. The concept of nominee directors, is that still something in practice and possible to apply in Malta?
It is, yes. Keep in mind that, again, directors as a service it's regulated under AML legislation as well. So the nominee directors or service provider directors would need to apply significant amounts of due diligence and always document and evidence a certain level of diligence in their activities. That being said, you would expect this of any director in a company, but keep this in mind if you're engaging service providers. We are a service provider, or we operate a service provider that actually provides a service, and we like to exercise a significant level of due diligence and good governance in the structure. And so you'd need to appreciate that it's both a legal requirement from a corporate perspective and from an anti-money laundering perspective also. With that being said, so the company secretary then is much more of an administrative role. One thing I want to mention is that the company secretary is also considered to be an officer of the company. So even though they do not have that decision-making role and that management role, they're also liable to any penalties that might be applicable to the officers of the company. And I think I can move on to the more interesting part.
Yes.
Essentially, the Income Tax Act provides for quite a few available refunds to Maltese companies, and which are very attractive for non-Maltese owned corporate structures. The one that we normally see used in practice is the 6/7 refund, but there are also a number of different refunds, such as the 5/7, 2/3, and even a full refund on tax paid in Malta. Just generally on the legal provisions. So what is important about the refund here is that the law provides that a person who is in receipt of a dividend paid to them by a company registered in Malta from profits allocated to the Maltese tax account, which is generally speaking where we would allocate that active business income, or its foreign income account, may claim a refund of 6/7 of the tax that is suffered by the company on those profits distributed to them by way of the dividend. Now, I'll explain this with a numerical example, but just briefly, what you need to have is your company must receive this, what we refer to colloquially as active trading income. The Maltese company has to pay the income tax at 35%, so there is this outward payment of 35% on the profits of the company. Out of those profits, the company would then be required to declare and pay a dividend to the shareholder, and I'll discuss the payment of the dividend issue in a little bit more detail. And it is then the shareholder that is eligible, so the shareholder of that company, who is eligible to receive a refund of 6/7 of the tax suffered, which essentially equates to an overall effective rate of 5% of Maltese tax. As a matter of procedure, the shareholder needs to be registered to receive that refund. And what we'll talk about now when I go to the diagram is matters of timing, ensuring liquidity, because you will have a period where your 35% has been paid, and how long you would expect to obtain the refund. Let me just go to the example. So in this example, this is a very simplified example where you have a single Maltese company, which is owned by non-resident, so non-Maltese resident shareholders. And what you would see at the bottom there in step 1 is the Malta company receiving an amount of 100 in chargeable income and taxable income. The second step, the Maltese company would pay the tax at 35% to the revenue, leaving you at step 3 with a 65 worth of dividend, which can be distributed to the shareholder, and then the shareholder reclaiming the refund in the amount of 6/7 of the tax that was paid. Just by way of information, there are no other taxes, no withholding taxes on distributions to non-residents. And keep in mind that if you're going to, as an individual, hold a Maltese company and look to benefit from something like this, you need to make arrangements, because there are specific rules that apply to Maltese residents, such as deemed distribution rules, which would not otherwise apply to non-Maltese residents. And we can go into that in a bit more detail in the next slide, actually. Something that we see done often is where the individual shareholder does not wish to receive, for whatever reason, the Maltese refund, but would only wish to receive dividends, is to incorporate two Maltese companies. And essentially what you have here is, again, the exact same system, except with the interposition of one Maltese company in between. So you have a Malta Co. being the bottom company, receiving that active income, paying the tax at 35%, distributing a dividend to its holding company. It is then the holding company that receives the refund. And then after that, the holding company has the option to either reinvest the entire funds, distribute them upwards as a dividend, or have a mix of dividend distributions and reinvestment.
Michael, and why would clients prefer to have this holdco in place instead of taking the tax refund directly and the dividend directly from the operational company?
Well, generally, it may be a number of matters. So, for example, where you have multiple shareholders, it's generally easy to focus the dividend payment and refund receipts into one holding company and then only distribute dividends to your shareholders, as opposed to having multiple distributions, multiple tax refunds. In other cases, it may be a tax planning requirement or a tax advisory requirement whereby the refund may be taxable in the hands of the shareholder, but the dividend would not, and therefore you would prefer having refunds received in the holdco level and receiving only dividend income from your multi-structure. There's a number of reasons. It's usually a mix of the two I just mentioned.
Yeah. And I understand that the shareholders, the foreign shareholders or non-resident shareholders, can both be corporate and private shareholders. So yes, there's no requirement to have a holding company abroad as well.
Correct, yes. Something that I really want to mention, which is important, these are things we encounter on a day-to-day basis. So number one, if you're implementing a structure like this and are yourself holding shares directly in a Maltese company, and you also intend to become resident in Malta, you should be seeking tax advice before doing so, because Malta, like I mentioned earlier, operates deemed distribution rules in terms of residence, which would mean that if you had a direct shareholding in the company, you would not have the option of not distributing dividends and purely reinvesting them. You would have deemed distributions at every time, and that may lead to withholding taxes and possibly further taxation at the Malta level.
Okay.
Another thing, which is where in terms of point number two, you have the tax payment, and that tends to be an issue with a number of people when they're deciding whether or not they want to operate a structure like this, being that since you need to make the tax payment, you stand to have a period where you're low on liquidity. What tends to happen in practice is that you may choose to distribute the dividend, yes, and apply for the refund, but you may also choose to not pay the tax until the refund is approved, at which point, once your refund is approved, then you pay your tax. You've satisfied the tax payment requirement, and then the refund is paid to your shareholder, which shortens the period within which you have a tax payment that's out and you're waiting for your refund in.
Yeah, okay. And on the active income part, that can be Malta-sourced income, but could also be foreign-sourced income, I understand, as long as it's active income.
Exactly. So generally, it would be most non-exempt income that would fall outside of passive interest or royalties. But again, in terms of passive interest or royalties, you have your 5/7 refund, which is not as attractive, yes, but still useful. Yeah. Finally, I'll just say this, which is that in terms of your refunds, dividend payments, and reinvestments, the system itself is very flexible, but always be sure to document your transactions properly. So what I've outlined here is the legal procedure by which this happens. In practice, for example, the shareholder can direct to the tax authorities that the refund is paid back directly to the Malta company at the bottom. In certain cases also, the shareholder doesn't require that the refund is physically paid to them, so they allow the Maltese company to retain the dividend. That is fine, but what you should be doing in that case is making sure that even from an audit perspective, you're papering all your transactions properly, and you're documenting. What I mean is this, that if you as a shareholder are owed a refund, but you wish that refund to be paid by the tax authorities to your Maltese company, that would have the same legal effect as you receiving the refund and you making either a contribution back down into your company, contribution to equity, or a loan, and it should be documented properly and accordingly. Same with if you don't intend to actually receive the dividend should still be recorded. It should still be allocated to the account of the shareholder. And if the shareholder does not wish to physically receive his dividend out of his account held by the company, there should be a documentation of that dividend being reinvested back into the company in whatever way you decide.
Okay.
And now briefly on the participation exemption, I'll move a bit more quickly. But essentially, wherever you have, so Malta does operate a very standard participation exemption regime. Essentially, what it requires is that where you have an equity holding, meaning where you have a Maltese company holding shares in another company which confer on the Maltese company either any two of the right to vote, right to profits, or assets upon a winding up of that company, and you satisfy any of the other following requirements, usually the most commonly referred to as a 5% shareholding. So your equity holding is 5% of the equity in that other company. Then you will be exempt from income and gains derived from that holding. Just briefly, when it comes specifically to dividend distributions and dividend and exemptions on dividend income, you need to consider and you need to apply. So you need to satisfy an additional requirement, which is any of these following, being that you're holding by your Maltese company in that other company. So the other company must either be incorporated in the EU. That other company must be subject to at least 15% tax, or the company does not have more than 50% of its income derived from passive interest or royalties, not passive income, but passive interest or royalties, very strictly defined. Or the holding is not a portfolio investment, and the company or its passive interest or royalties, again strictly defined, have been subject to any foreign tax which is not less than 5%. Apologies for rushing through. I'm just mindful of the time.
No, I think I'll have to do the same on the Belgian part. I think I will, have to skip this one because we getting a bit short on time. Still, there's I think about 10 questions. So I think it makes more sense to spend a bit more time on answering those. So very briefly, that we have a special tax status in place as a bit of a comparison to the regimes that Malta could offer as the resident non-dom regime, for example. We have something similar, but I guess if viewers have further questions about it, they can contact me directly. But I think I'm going to have to skip it because it's going to lead us too far. Maybe just one final thing on the crypto, because of course,
yes.
Like you mentioned, Michael, I think Malta was one of the first to adopt regulation on crypto. So maybe if you can just give a bit of background on that.
Yeah.
And I understand that your numerical example is the same as what we discussed a few seconds ago with the Maltese structure. So I give the word back to you, and then we can conclude the presentation and go to the questions.
So essentially, when it comes to crypto, like Gregory just said, Malta was an early adopter. In fact, we went about coining our own term for cryptocurrency, which was the virtual financial asset. Essentially, however, the bottom line is that from a tax perspective, the tax authorities took a much more realistic approach, and what they decided, and I tend to be in agreement with this approach, is that when you are looking at the taxation of cryptocurrencies and digital assets, what you look at is what that asset represents in actual fact by means of its use. Meaning that if that asset is something that we already understand within the concept of tax treatment and within the concept of business, then it is going to be taxed as such. And what I mean by that is, I'll just move to the next slide. Very briefly. So what the tax treatment is, focus on is this: your DLT assets, your digital assets may be made up of already existing financial, let's say, assets, being that coins such as Bitcoin, Ethereum, etc., which are used purely for payment. And essentially, the tax authorities say we deem these to be the equivalent of fiat currencies. You also have the concept of financial tokens. And again, what is being said here is, if it looks like a security, I will tax it as such. And the treatment is, wherever your crypto takes the form of an equity, any type of security that we already understand exists within the financial markets, we will tax it as such. And then utility tokens, which themselves are based on pure utility and the pure obtaining of a good or service that is linked specifically to that token. Ultimately, they also said that you may also have a combination of a coin, a financial token, and a utility token. This technology is getting more and more complex and more interesting. And what the result of that is that whatever transaction you carry out with your crypto, at the time that it is carried out, whatever that transaction represents is how it will be treated for tax purposes. One moment. In terms of if you were to hold cryptocurrency and invest in cryptocurrency as a res non-dom individual in Malta, again, you would expect your crypto investments to be taxed, or income and gains from your crypto investments to be taxed on a source and remittance basis. So what's important to understand here, like I said, the treatment is going to be as we've already discussed it for any other kind of income. However, keep in mind that when we talk about here income arising from foreign source crypto not generally being taxed in Malta, it doesn't just mean that you may hold crypto in a foreign exchange, actively trade it while you're sitting in Malta, and then not be subject to taxation, because that would then lead you to be taxed on income arising in Malta. What it means is that if you have foreign source crypto and depending on the makeup of that cryptocurrency, that you realize certain items of income which would be deemed to be arising outside of Malta and are not remitted to Malta, that is where you're not taxed. In terms of gains, capital gains, cryptocurrencies being the standard Bitcoin, etc., those would generally fall outside the scope of capital gains, so there would be no tax on your long-term holdings of crypto and the sale of your long-term holdings of crypto. I've added a few more examples, but I think we can move to the company example. If there are any questions, please feel free. I'll stay on for the Q&A and we can discuss in more detail. When it comes to companies, again, you're going to have, like I said previously, where the crypto is treated as a more traditional kind of asset, that will be the tax treatment, meaning that coins would be treated for tax purposes as if they were fiat currencies. Therefore, if you ran if your company carried on the business of exchanging coins and profiting from exchanging coins, it would be similar to taxation on income from exchanging fiat currencies. again, returns on financial tokens, for example, returns on a token that is treated as an equity or a share in a company, would be treated as if your company had an equity holding in another company. So you would look at your dividend income, how that is treated for tax purposes, whether possibly you would be exempt in terms of the participation exemption as well, because your holding is an equity holding at the end of the day. And then on transfers of either financial or utility tokens, again, this would depend on what the actual transaction surrounding that transfer signifies in terms of how it would be traditionally seen from a Maltese income tax perspective. Again, like I said, you will likely be able to apply your refunds and possibly exemptions to these transactions. And this is just a brief case study. As you can see here, this would be exactly the same treatment as we discussed for a double Malta holding structure, where you have an operating company that itself owns cryptocurrencies, trades and exchanges these cryptocurrencies, and then realizes profits on those trades. And you would have your tax payment at 35%, your dividend distributions, and your subsequent refunds.
So trading, exchanging crypto would qualify as active income, I understand.
Yeah, yes, exactly. And there's no fixed rule as to how often you would be seen to trade. So the frequency of the trades would lead to you classifying that as income from trades. But then we apply what we call the badges of trade to determine whether or not jurisprudence would agree that you're conducting a trading activity versus a long-term holding of passive assets.
Okay. I think maybe we can conclude the crypto topic here. I do have a few slides on the Belgian tax treatment. Now, this has been in place already for quite a few years, so we are not really an early adopter of crypto regulation, to say the least. We do apply the traditional taxation of investment rules on crypto gains. So basically, you have three categories, and I think we can just summarize it here. So if you are what we call prudent investor, then normally you are fully tax exempt. So a person that invests their own assets rather in crypto as opposed to putting it on a savings account or in another financial asset, the tax authorities are of the opinion that your gains are tax-free. Now, as soon as there's what we call speculation, so you're actively trading, you're lending money from friends and do the investment on a more active basis, then you shift to a 33% capital gains taxation. And obviously, if it becomes a business, then it's business income. So I think that's more or less it on the Belgian tax part of crypto. But I think, viewers today are mostly interested in the Maltese approach. So I think we can then jump to the questions. I have about 10 questions, I think. Michael, you can see them on the chat as well?
I cannot.
You cannot.
See if I can
Are you able to open the chat? Or I can just read them out loud. It's not a problem. So the first question is English the official language? So every document is written in English in Malta. I think that's effectively so.
So that's joint English and Maltese, but generally all business documents or submissions to the registry are done in English. Yes.
Yeah. Okay. The second question was about the 6-7 tax credit. If you own an LLC company, also as a managing director of the company, as well as the owner of another LLC in Belgium. But I think we went into detail on that during the Maltese business setup. So I guess if people have more specific questions on the tax refund, I guess they could contact you directly. But I think we focused on that during the presentation. The third question, if as an EU nationality, if an EU national resides in Malta after pension age, is the pension income from Belgium taxed as remittance? So I think that is a question for me in terms of which pensions remain taxable in Belgium, and a question for Michael, what tax status the beneficiary of the pension would have in Malta. So on the Belgian part, most tax treaties, I can say that Belgium has concluded they refer the right to tax pension to the country of residency. So in this case, if Malta is your country of residency, the right to tax would go to Malta, with the exception of what we would call social security benefits. So if it's effectively state pension, in most cases, again, we have to look at every situation in detail, but in most cases, state pension remains taxable where, let's say they're paid from at the source country. So the right to tax on state pensions would normally go to Belgium. But for private company pension plans and other types of pension, the right to tax would normally go to Malta. But again, we have to check it in the specific situation. And I think, again, like I said, I think it also depends on your tax status in Malta, because you can only invoke the tax treaty with Belgium if you can, of course, qualify as a tax resident. Michael, I don't know if there's anything you want to add on that part.
The only thing I'll add, you've already touched upon it, but then the actual tax treatment in Malta, at least insofar as the brackets are concerned, would be what regime you fall under. And I'll point out here, generally just for information purposes, there's also a retirement program in Malta which lowers the tax rate on pension income. I believe, off the top of my head, I think it's 15%, also similar to the residence program. So in the event that your pension income is actually taxed in Malta, you may also benefit from lower rates under certain regimes. So we'd look into that on a case-by-case basis.
Yeah. Fourth question, is rental income from Belgium when transferred to Malta taxable under remittance rule? I don't think so. Is this considered to be capital income, or would it fall under the... So it's rental income. So the client, if the client has property in Belgium and lives in Malta, because we would, of course, tax it, like I said in the presentation, on the deemed rental value basis, because the general rule in tax treaties is that property is taxable where it's located. So, of course, property would effectively be taxed in Belgium. The double tax treaty avoids double taxation. So in normal situation, Malta would not tax Belgian rental income. I don't know, under remittance basis, would this somehow trigger a taxation?
No. If it would still not be able to tax the income, then that would be it, as I understand it. So no.
Okay, yeah. Question about recent visiting Belgian tax authorities about holdings in Malta. So I need to maybe add a bit of information on that. There was some, let's say, investigative journalism on Belgian residents and Belgian companies holding companies in Malta. So it was in the Belgian financial newspaper a few weeks ago that suddenly they discovered a bit similar as the Panama Papers and everything else they discover out there, that quite a few people have a company in Malta. So the question here is there still that no common culture in Malta as it was approximately 10 years ago? So I don't know if that's something you want to answer in detail, but I guess
but actually, so first of all, I'm sorry, because I'm seeing the Q4 and Q4 over here. No, I was referring to
I don't know. Before. Yeah, it's another question, I guess. It's Q5. Yeah.
So not so much. In fact, now, especially after we've implemented beneficial ownership regulations, etc., it's a pretty, I would consider Malta, I wouldn't say it's open source, but very much more open in terms of the way things are done, corporate ownership. It's all there. It is technically public information you can access now. It's a lot more transparent than it was 10 years ago. That I can assure you.
Okay, thank you. How much does it cost to set up an LLC in Malta? An annual run cost? For instance, in Belgium, you need a capital of 5,000–6,000 euro. I mean, that's not entirely correct. There's no minimum share capital, but yeah, it's a bit free for the basic limited liability company. You're free to decide what share capital you have. Annual accounting fees, I don't know, in Belgium would any be around between 3,500 and 5,500. A setup cost in Belgium would be around 3,000–4,000 euro, I guess, with the notary and the financial plan and everything. Would that be similar in Malta? We're looking at something similar, or?
At a base level, you could say yes. And this is where you need to be careful about the cost of the company. So you may set up your very standard limited liability company with around that much. You need a minimum share capital of 1,200 euros, which you need to pay a minimum 20% of. You could in theory incorporate a company just under these figures, similar to the figures you just mentioned. But then again, what you need to do is planning before that to see, do I need a director? And do I need a nominee director, for example, or a service provider director? That will drive up your fees. What are the number of transactions I'm contemplating? Will I need legal support to put certain documents in place, whatever it is, whether it's loan agreements, service agreements, employment agreements? These can all drive up the cost, but I'd say your basic cost is around that much, a little bit lower than that. And your annual costs just about the same. In reality, when you have a fully fledged and operating company, those costs will easily double and in some cases exceed that, but take it on a case-by-case basis.
Yeah, okay. I presume that's something I always need to refuse clients in Belgium, that we don't provide virtual address services because we're not allowed to as a law firm. Is that similar in Malta? Do you provide a legal address for the company?
Our corporate service provider does provide that service. It's not necessarily a virtual address. So you would have a full corporate secretarial and board support system in place as standard. But then you would also be able to rent physical offices. And in fact, our CSP also has a sister company that operates physical office spaces and services then. So yeah, at minimum, you'll have you can incorporate with a registered address provided by your corporate service provider, but you would expect to have a full complement of corporate secretarial and board support work being done in tandem with that. At minimum.
Okay. Yeah, okay. Which bank do you recommend for a limited liability company in Malta? I don't know, do you have any preference there? Are you receiving commissions from any banks, or?
I was going to say jokingly, none of them, because they all make my life difficult. No,
yeah, okay.
No, look, a number of banks we've worked well with in the past, and I'm in no way soliciting for these banks in any way whatsoever. It's just from personal experience. You may consider Sparkas Bank, which generally I find is one of the more upstanding banks to work with. There's also another bank in Malta called Agribank, which is a younger bank, maybe less tried and tested, but is also a good bank to work with. I think those are the only banks I find worth mentioning. Again, this is no I'm not
no commission based. No, of course, no. Yeah, then the nominee directors question we answered. A question to Michael. Maybe you can just read it. Can you see the question, Michael? Because it's quite an explanation. So the question is, when a dividend is paid from a US business to the Maltese holding, there's a possible refund of 6/7 of the tax of the holding in the Maltese entity, though it will be active income for the EU, Belgian residents that own shares, which will be handled in the double tax treaty within the EU. So in fact, there will be a shift when there's a maximum of 35% income tax with a 50-50 for the Maltese Belgian tax authorities. In the US, there has been paid already 21 to 35% to the IRS. So I guess that's corporate tax. Did I take the right rank here, or is there a hole in my analysis? I don't know if that's something you can just easily answer like that. Otherwise, we'll have to come back to that.
Easily, no. It's a super interesting question. I think there might be there may be. So when a dividend is paid from the US business to the MT company, yes, there's a possible refund. Tax of the holding in the MT, possibly. So first of all, when the US company pays a dividend to the Maltese to its Maltese holding company, assuming that dividend is not already exempt under the participation exemption, you may be taxed in Malta at 35%, and generally, I believe you would attribute that to your foreign income account. So you would be able then, once your Maltese holding company distributes the dividend to its holding company, to its shareholders, then the shareholders are eligible for that refund. So it's not. I refer to active income because it was in the sense of usually it's from trading income, but in this case, if you have a holding and subsidiary relationship, you may allocate that income to your foreign income account, which would mean the treatment is slightly different, although you still end up benefiting from the refund. What I don't
Okay, maybe the question was from Cornelia. Maybe Cornelia, you can contact Michael directly if you want to further discuss, because I want to keep it under 1 hour and a half. We have 5 minutes left.
I'm sorry.
So I guess that
please do get in touch if you'd like to discuss in more detail. This is a very interesting question.
Yeah. Okay. Thank you in any case for the question. I think the last question, are there any tax on transfer of shares in a Malta company from owner to owner children or other directors? So I guess that's sort of like a transfer tax or anything. Is that
first of all,
taxable event?
What's important is let's make the distinction between shareholder and director, because it doesn't necessarily mean that when you transfer as a shareholder, even if you are a director of the company at the same time, but you are transferring in your capacity as a shareholder to another existing or prospective shareholder. But essentially, no. Especially when you're dealing with non-residents, there is no capital gains considerations or transfer tax on transfers of shares, so that is completely tax-free, so out of scope, at least from capital gains tax and any transfer taxes, depending on, because you're mentioning children here, you may need to look at the provisions of and whether or not you're a resident, you may need to look at provisions of duty
tax,
that
maybe
apply to donations, although these would generally be exempt as well. So the short answer is no.
No. Okay. I guess that's it on the questions part. So for everybody attending, thank you for the questions. Michael, thank you for your time and putting your efforts in this. The presentation itself has been recorded, so it will be made available to you in a few days. We'll also put it on our YouTube channel, but you'll receive a separate email for your information. You can still consult it again if you want. So again, Michael, thank you. People, if you have questions about Malta or Belgium or both, you know where to find us. Thank you again for the presentation and hope to see you at a future webinar. Thank you.
Thank you all.